Aligning financial services in this way allows us to identify three cornerstones of FinTech: PayTech, Capital Tech, and InvestTech, a FinTech framework. This is the framework within which many of the FinTech startups are based. We have startups operating in one area or another, and some of the larger FinTech players operating in all three. Globally, the incumbent establishment is also adopting this framework and adapting their existing operations to suit. Locally, this includes familiar names such as Danske Bank and specialist financial services, homegrown success stories such as FinTrue, First Derivative, and in InsurTech there is Allstate Northern Ireland in the form of Arity. In RegTech there is FScom and others. The list goes on. At the end of the video I have included a map of the Northern Ireland FinTech ecosystem, which will let you see the breadth and depth of engagement and activity taking place right on your doorstep. The most progressive of incumbents are realizing that this transition will take more than adapting their existing provision. It will actually involve rebuilding their provision from the ground up, or in tech speak, from the back office out. This realization has led many traditional banks to partner with a selection of specialist fintechs as the best way of making the transition. Others have decided to go it alone. The standout example is surely JP Chase, one of the world's oldest and most powerful banks, one of the true incumbent giants. Among the first to truly appreciate the scale of threat on the horizon, their CEO famously remarked only a few years ago, "We cannot let Silicon Valley eat our lunch." And they reacted accordingly. So comprehensively has JP Morgan embraced FinTech that they now employ more software developers than Facebook and Twitter combined. Approximately 50,000 developers in a workforce of 165,000. It begs the question, is JP Chase really still a bank? Or are they now a tech company that does banking? The lines are blurring. Many other incumbent banks and financial institutions are following suit, and those who don't run the risk of disappearing into the annals of history to be replaced by the so-called challenger banks or neobanks, banks with no physical branches. The United Kingdom has three very successful examples of challenger banks in the shape of Monzo, Starling Bank and Revolut. Now, in building this structure, I referred to two very fast developing technologies: crypto finance and artificial intelligence. We noted how these technologies entered into each of the three key FinTech areas. In actual fact, they underpin them and are enabling new areas of finance in addition to enhancing the possibilities within existing areas. The distinction between the terms enhancing and enabling encapsulates the difference between what we may call FinTech and what we may call TechFin. We began our discussion of FinTech by pointing out that the field of financial services has always been linked with technology and innovation, dating back to early civilization. If that's the case, why do we need this new terminology, FinTech or TechFin for that matter, to describe the present day? What's so different nowadays to have generated so much buzz and to be receiving so much attention? The critical difference lies in the fact that over the past 15 years or so, financial services innovation has taken a significantly different path than before. And the reason for this is who's leading the charge. Historically, financial institutions, the banks, the investment managers, the hedge funds, have been the pioneers in most technological innovations, from money to checks, to credit cards, to ATMs, to online trading, and so on. Recently, however, it has by and large been the technology companies who have been breaking new ground. For the first time in the history of financial services, we are seeing companies like Google, Amazon, Facebook, companies we don't think of as financial institutions, and when compared to the incumbent establishment, didn't even exist 5 minutes ago. We see them beginning to take on core financial services functions right across the financial landscape of transferring, raising, and investing money and capital. This is partly because of the big data boom and technology companies having hitherto unheard of levels of access to consumer data, and partly because technology companies are not subject to the same regulatory stringency that financial institutions are. As a direct result, they can afford to be significantly more aggressive in taking on risk, in developing new products, new technology, and opening new markets. This has led to a situation where traditional financial institutions are in danger of being left behind on many technology fronts by companies who have never even done finance before.